The current thinking is that the ride may have ended at mid-year, really kind of leaving us in the same place as we started the year. But if the ride restarts due to the new tariff actions, the experience of the last 6 months really gives us confidence that REITs are well positioned to weather additional volatility and thrive.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. In today's episode, I'm speaking to Ed Pierzak, REIT's Senior Vice President for Research. Ed is with me to highlight some of the key themes and findings of REIT's 2025 mid-year update. Well, Ed, thanks for joining me today on the podcast.
Well, Sarah, my pleasure to be here.
So to kick off, why don't you recollect how expectations stood coming into 2025?
Well, for 2025, we had big expectations for both real estate and REITs in the coming year. Our outlook called for solid economic conditions. In addition to that, we expected a convergence between public and private real estate valuations. And these are really two critical keys for unlocking the property transaction market. So with our optimistic economic outlook, we also thought that REIT performance would delink from its inverse relationship with interest rates. So at the end of the day, REITs were really poised to start a growth trajectory with their well-managed balance sheets and efficient access to capital.
So Ed, sitting here today, as you look overall, what's been the reality for the last few months?
We had a solid start to the year, but then we did hit some turbulence, and this was really driven by new directions in trade policy and economic uncertainty. So it's really been a bit of a roller coaster ride.
And would you say that things have really started to settle at this point?
By mid-year, it really seemed like the ride may have ended, essentially leaving us in the same place where we started the year. But we've had some new developments. The new recent tariff actions, we think that the ride might start again. But if uncertainty continues to dissipate, our brighter outlook is still on the horizon for both real estate and REITs.
Right. And Ed, let's look a bit more closely at the factors creating uncertainty in the REIT market and how they've manifested in terms of actual performance.
Sure. We've had some new directions in tariff policies, and that has certainly introduced some uncertainty into both U.S. financial markets as well as economic markets. And so when we take a look at overall, say, equity market performance, prior to Liberation Day, REITs were outperforming the broader equity market. But when we've had the announcement of the reciprocal tariffs, that's really when the roller coaster ride started. When we take a look at the impact of that announcement, we really find that it had similar adverse impacts on the broad equity market and the REIT markets. All 13 property sectors declined as well. Interestingly enough, when we had the temporary pause on reciprocal rates, markets bounced back in those 5 trading days. And we also saw gains across all of the REIT property sectors, but these gains weren't enough to offset the initial declines. Year-to-date performances for both the broad equity and REIT markets are both positive. So in a lot of ways, the takeaway here is that the impact of tariff actions have been more tempered than many investors feared.
And Ed, higher interest rates have been part of the scenery throughout the first half of 2025. How has that played out in terms of REIT returns?
We talked to a lot of investors and consultants, and there's really been a consistent concern over higher and or rising interest rates. For those that are worried about higher rates, our analytics show that real estate has performed well in low, mid, and high interest rate environments. Importantly, REITs have outperformed their private market counterparts across each of those interest rate regimes. But for investors who are worried about changing interest rate, NAREIT has found that REITs have enjoyed positive total returns about 75% of the time in both rising and falling interest rate environments.
And what about the relationship between REIT returns and the 10-year Treasury yield? What does that tell us?
Well, REITs have really had this inverse relationship with the 10-year Treasury yield since 2022. And essentially, if the 10-year Treasury yield goes up, REIT returns go down and vice versa. And when we, again, talk to investors, some question whether or not this is a forever relationship. And certainly history shows us that REIT total returns and 10-year Treasury yield changes, they've had both positive and negative correlations. And each has occurred about half the time since 2000. And so as the outlook for the economy becomes more optimistic, we believe that this inverse relationship will change and ultimately go to a positive relationship between both REIT performance and treasuries.
And Ed, turning back to REIT fundamentals for a moment, the state of balance sheets is always top of mind for investors. Have you seen any concerns in that direction?
Really no concerns, but with uncertainty, balance sheets often take center stage. And certainly REITs have not been immune from market movements, but they have been very well insulated. When we take a look across the board, we take a look at leverage ratios. They remain quite low, currently at about 33%. REITs have been using really the majority of their debt is fixed rate debt. That's over 90% of total debt. In addition, unsecured debt is roughly 80% of total debt. And when we take a look at the term to maturity, it's greater than 6 years. So they're really well insulated from any market movements that are occurring today. And then lastly, their cost of debt remains quite low. It currently has an average of 4.2%. I would say given all these factors, REITs are really well equipped to weather potential future turbulence.
So, Ed, do you think it's accurate to say that at mid-year the markets have settled and recession-related concerns have abated?
After a period of turbulence, I think we certainly thought that we had a degree of stability that had returned to the marketplace. And granted, we have some new developments that may upset that, but to take a look at uncertainty overall, we look at a variety of metrics. We could take a look at the probability of recession in 12 months. We take a look at the VIX. In addition to that, we could take a look at the BAA spread. And each of these measures started the year low. They all reached a peak post-Liberation Day. And then at the end of June, they're basically back to the same levels that they were at the start of the year. And so right now, it's currently unclear if the recent new tariff actions will drive uncertainty higher, but there has been no meaningful changes in either the VIX or BAA spreads to date.
And as we round out this mid-year outlook, what should REIT investors really take away from how the sector has performed so far in 2025? And how do you think REITs are likely to be incorporated into investment portfolios as we look ahead?
Whether REITs liked it or not, REIT investors had a front row seat on the roller coaster ride. The current thinking is that the ride may have ended at mid-year, really kind of leaving us in the same place as we started the year. But if the ride restarts due to the new tariff actions, the experience of the last 6 months really gives us confidence that REITs are well positioned to weather additional volatility and thrive. And so as we kind of look forward, a few things come to mind. Number one, REITs will continue to be leaders in trends that matter. And 4 trends that are really important to future performance include specialization, scale, innovation, and sustainability. And I think that a lot of investors today are recognizing this, and they are increasingly making REITs a larger part of their real estate or real asset portfolios.
Ed, thanks so much for your time today.
Thank you.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.